I'm an investment specialist with Phillip Securities, and today I'll just be bringing you through some of my views, okay, on the US market outlook and how you may want to position yourself moving forward. Okay, so first of all, I think it's important for us to have an overview of actually how the US market has performed thus far. So of course, we see that all three main indices have seen a strong double-digit rebound, okay, since 23rd March. Okay, Nasdaq has led the way, okay, delivering a 3-month return of more than 36%. Okay, just now from the previous Q&A on the Singapore market outlook, okay, sorry, I see some of you actually asked, whether we can actually go back to the 23rd March low. Okay, my personal opinion is that we have already established a market bottom then, okay, on the back of Fed strong support, okay, with its whatever it takes stance, and of course the fiscal policies that is in place, and also that is coming up soon. Okay, I think it will be difficult for us to actually see those price level again. Okay, moving on to specific sector breakdown. Okay, we see resilience in the IT sector. Okay, we see resilience in consumer discretionary and communication services. Okay, so if you look deeper, actually these sectors are partly being supported by the FANG stocks. Okay, so year to date, okay, FANG stocks actually see a more than 30% average return. Okay, of course, IT proved to be the most resilient during this crisis. Okay, this is because reason being, investors see these tech companies, okay, as a beneficiary, okay, from this COVID-19. Okay, so this pandemic will definitely see some acceleration of shifting trends, okay, towards remote working, okay, towards cloud computing, and of course, there will definitely be a need for more robust telecommunications infrastructure. Okay, so one question that has been on everybody's mind is that how has reopening been? Okay, so from the mobility trend report, okay, we do see that US citizens have been getting out of their home. Okay, mobility has started to shift towards normalcy. Okay, but we do see that people are actually choosing to drive. Okay, and there is actually a weak transit. Okay, transit meaning taking a public transportation. Okay, as you can see from the purple line there. So of course, this low ridership could be due to fear of virus spreads, okay, on public transportation, and also with social distancing, okay, there is a lesser frequency of public transportation. Okay, so many people are actually turning towards driving their own car instead, and we can also actually see this through the retail sales you can actually see this through the retail sales in May, which later I'll be bringing you through on. Okay, but of course, a main threat that we are seeing is that the resurgence of virus outbreak, okay, or what we call the second wave. Okay, last night I was just looking at the Florida and Texas mobility. Okay, it has actually started to taper down. Okay, so people are actually getting wary. Okay, they are not going out that often anymore. Okay, so do watch this space. Of course, from the Google Mobility report, okay, same thing, okay, two strong trends that we see. Okay, one, of course, it reinforced the fact that there is low ridership for public transportation. Okay, but second thing is that, with all this reopening, right, if you were to look at the mobility to workplaces, okay, it's actually still down around 12%, okay, compared to pre-COVID period. Okay, so it does mean that there could be some form of permanent shift, okay, towards working from home, okay, despite all the reopening in place. Okay, this is in terms of air travel. Okay, we are seeing a gradual recovery, but it's definitely still far below pre-COVID levels. Okay, of course, reason being could be that there is still several travel restrictions that still remain in place. Okay, and with the threat of a second wave, definitely we will see some delay in terms of lifting of all these travel restrictions. So I expect demand for air travel to remain suppressed, okay, of course, in the near term. Okay, as you can see, EU countries recently they have just barred US travelers from entering their country. Okay, in terms of some macroeconomic indicators from reopening, of course, we have seen a strong rebound in advanced retail sales. Okay, it's a strong growth of 17%, okay, from April to May. Okay, some reasons for this, of course, we are talking about pent-up demand. Okay, we are talking about retailers providing widespread price discounting, okay, upon reopening. And of course, most important is that we are actually seeing a one-time cash relief check, okay, that is actually provided by the US government. Okay, so this is, do take note, this is actually a one-time. Okay, they are still in discussion on whether they will want to continue. Okay, this one I'll touch on it more later. So definitely, I do believe that you will need more stimulus checks. Okay, that will be needed in order to sustain this continued growth in retail sales. Okay, but as long as people are actually going out and spending, going out to spend. Okay, among all these reopening. Okay, of course, consumer sentiments similarly shown a huge improvement. Okay, even though there is still a huge gap to cover, okay, to reach pre-COVID levels. Okay, why this is important is because consumer spending actually represents more than 2/3, okay, of economic demand in the US. Okay, but one thing we see is that savings rate, okay, even though it has dropped from April, okay, but it still currently stands at around 23%. Okay, we have to take note that usual historical savings rate for the US is roughly around 6 to 8%. Okay, so with savings rate at 23% with reopening, okay, we do see that even though economic reopening indeed helped to boost a bit of a spending power, but there could also be a structural change in consumer habits, okay, whereby people are still wary of the economic situation at hand. Okay, for industrial production, okay, this is more on the firm side or manufacturing side. Okay, it has a very slight upward revision. Okay, at least we know that factories resume at least partial operations. Okay, following all the suspension from lockdown. Okay, so capacity utilization, okay, only inches slightly higher. Okay, it is still far below the average historical utilization rate. Okay, if you were to see the chart, actually you will notice that there's a dot indicated there. So this dot actually indicate, okay, the start of the trade war, okay, between US and China. So from here you can see that actually, despite US starting the trade war, okay, it is actually having a negative impact, okay, on the US industrial production, okay, which mainly consists of manufacturing firms. Okay, but at least good thing for now is that, sorry. Okay, at least good thing for now is that we have seems to have established a bottom. Okay, there's a saying that goes, if you hit rock bottom, okay, the only way to go is up, right? And I think this is actually what we are seeing here. Okay, lastly, for US unemployment, okay, past few days, okay, we have seen positive news on the US unemployment actually falling, 11%, US unemployment standing at 11%, okay, which is actually a surprise result. Okay, so but if you were to look deeper, actually, for this US unemployment rate, even though it looks promising, okay, but they are just a snapshot of what the economy looked like in mid-June. Okay, this is because this is mainly done through a household survey. So this is actually a snapshot of the economy in mid-June. And if you were to think about it, actually a lot has changed since then. Okay, within these 2 weeks, okay, we are seeing COVID-19 infection spiking in states across the country. Okay, and we also see many governors, okay, they are actually rolling back, okay, in terms of their phase reopening. So of course, we know that this reopening actually, they do brought many jobless workers back into the labor force. So even if June unemployment report is states that we see a big gain in sectors such as leisure and hospitality. Okay, but the danger now is that we may see a claims rebound in those states where infections are rising rapidly. Okay, as people may start to stay away from a restaurant and malls. Okay, and this will relate to the mobility report. Okay, of course, from the chart, we see a decline in initial claims and continuing claims. Okay, but the decline seems to have slowed in recent months. Okay, so it brings a potential point that with reopening, okay, probably we are starting to see a second leg of a layoff. Okay, no doubt with reopening, people are getting rehired back into the workforce. Okay, but with this, okay, it may also bring out that workers are also being laid off on the other hand. Okay. So of course, what have been done so far, we have seen a strong support. Okay, of course, we all know that on 15 March, Fed funds rate has been slashed 150 points, currently close to zero. Okay, a question on everybody's mind is, will we fall into negative rate? Okay, as of now, the policymakers, okay, they are leaning towards not adopting it as an appropriate tool. Okay, but this policy will tends to be detrimental for the banks, definitely, and of course, potential negative impact on money market funds. Okay, it does remains an option for the Fed. Okay, but I do not see it being played out in the near term. Okay, if you really do see it, right, I deem it as being a very aggressive move, and we should be conscious that it probably means that the economy is not recovering as well, okay, as what they expect to be. Of course, Fed dot plot, okay, it suggests that rate will remain unchanged at least until the end of 2022. Okay, so we all know that definitely low rates will be here to stay. Okay, of course, another good thing is that Fed has been conducting large-scale asset purchase in terms of treasury, in terms of mortgage-backed securities to boost money supply in the economy. Okay, then and they also declare that they have started to buy up corporate debts. Okay, so they have this whatever it takes stance, okay, which is really an open-ended commitment to to keep buying assets to support the economy. Okay, and that is one of the reasons why I don't think that we will actually go back to the March low itself. Okay, I shall not bore you with all these policy details. Okay, but key points that we want to take note is that, okay, as of now, okay, total targeted fiscal stimulus, okay, stand at around 13% of US GDP. Okay, so as a relative gauge, if you were to compare among the G20 countries, okay, US is one of the highest, I think just behind Japan. Okay, of course, the more popular one, I'll just talk about the more popular one will be we always see in the media, the Paycheck Protection Program. Okay, it's mainly, to extend loans for small businesses. Okay, but the main key point is that it is here to retain jobs. Okay, so from the unemployment, from the improvement in unemployment that we see, okay, partly I believe that it's definitely for this due to this PPP. Okay, because we can see the first tranche, the take-up rate is actually it actually run out within 2 weeks. Okay, the second tranche, we see some form of taking up, but of course there is still some leftover. Okay, and that's why they actually extend it for 5 more weeks. Okay, but moving into Q3, a question to ask is, after these 5 weeks, what will be the next step? What will be the next move for them to actually support, okay, all these small businesses? Okay, monetary policy response. Okay, same thing. I shall not bore you with all this. Okay, but main thing is that one concern is that we are actually seeing a low pickup rate of policies. Okay, low pickup rate of policies. Okay, there are a few reasons. Sorry. There are a few reasons. Okay, of course, some reasons is that the economy is recovering. Okay, when Fed actually said that it intended to purchase up to it intended to purchase corporate bonds, okay, straight away they are able to boost confidence in the boost investors' confidence in the corporate bonds, and then we can see that investors, they begin starting buying bonds again, and eventually, like large companies, okay, they are able to resume issuing a large amount of new bonds, okay, like in the case of Boeing and also the cruise company Carnival, okay. Okay, but moving forward, okay, we do see a lot of policies ending. Okay, we do see, additional unemployment insurance ending at the end of July. Okay, it actually translates to a huge drop in purchasing power for the unemployed. Okay, so imagine you go home one day and then suddenly your allowance is cut by more than half. Okay, definitely you will cut back on spending, and all this will definitely affect retail sales. Okay, and another point is that on the firm side, okay, US leverage loan default, okay, it actually is higher than historical average. Okay, of course, this is partly contributed by Hertz, okay, the car rental company. Okay, but if we will have to see, okay, because if there is no further relief measures, okay, we may see this loan default amount, okay, starts to pick up again. Okay, of course, on the consumer sides of things, okay, on the housing side, okay, share of loans in forbearance. So forbearance is like, the banks, they let you delay on your mortgage payment, okay, but it doesn't mean you don't have to pay back. You still have to pay back, okay, but probably you pay back at a later date. Okay, and moving forward into Q3, okay, we may start to see some of these forbearance plans are ending. Okay, and this may in turn put pressure on these borrowers. So definitely more relief measures will be needed. And this is what we are seeing that actually coming up with more fiscal stimulus plan that is in discussion right now. Okay, of course, I'm remaining cautious on the US market. Okay, why is because ahead of us, we do see several downside risks, okay, which we need to pay attention to. Of course, what is on everybody's mind, okay, is in terms of second wave of outbreak. Okay, but how severe is this second wave of outbreak? Okay, I'll be providing you with the data. Okay, we do see new daily cases, okay, rising in 41 out of 52 states. Okay, of course, some states are more severe than the other. Okay, if you look at the transmission rate, okay, usually when you look at transmission rate, okay, it's the average amount of people that become infected. So if your transmission rate equals to 1, okay, it means that one patient, okay, they will tend to infect another person. Okay, 1:1. Okay, if above 1, it could potentially means that the virus has been could have the potential to spread quickly. Okay, so we do see a potential virus spread in 38 states. Okay, but of course, some of these states, they have very few absolute cases. So with having few absolute cases, we do see a higher chance of it keeping it under control. Okay, but definitely some state that we see, okay, definitely the situation is much more severe. Okay, and these are the states that I'm referring to. Okay, these are high-risk states. Okay, we see that in Florida, in Texas, in California, okay, the number of new cases every day is actually more than 6,000. Okay, this is per day. Yeah? Okay, not only will this hinder, reopening plans in this area, okay, I also believe that it may, okay, potentially pose a risk for the upcoming election. Okay, why is because if you look at Florida, okay, it's a potential swing state. Okay, if we look at Texas, okay, it has a history of voting for the Republican. Okay, same thing for Arizona, same thing for Georgia, same thing for Tennessee. So all these, if you look at the past few election record, they have the tendency to vote for the Republican. Okay, so moving forward, with the virus not being under control, spreading like wildfire, okay, it may potentially pose a risk of a loss of support for Trump. Okay, for failing to bring this virus outbreak under control. Okay, of course, with this second wave of outbreak, okay, I would expect that mortality rate will be better controlled. Okay, I mean, we have experience with the first wave. Okay, we are having a better equipped healthcare system. Okay, we are having more organized healthcare system. We are having more experienced healthcare workers. Okay, so definitely I expect mortality rate to be better controlled. Okay, we may not see a nationwide lockdown. Okay, it could just be tougher control measures in those targeted areas. Okay, why is because nationwide lockdown will be too costly. Okay, we cannot afford to take in another trillions of dollars in cost, okay, in terms of economic damage, and then the government has to come up with trillions of dollars of stimulus funding again, okay, needed to offset it. Okay, so based on this huge cost involved, okay, I definitely do not foresee a nationwide lockdown. Okay, but markets have been undergoing a V-shaped recovery. Okay, for that to happen, I believe that they have actually priced in a very strong economic recovery from reopening. Sorry. Okay, from the reopening. So with this virus second outbreak, right? Okay, currently it is still contained within those few states. Okay, but if you were to see it, spreading across the country, okay, definitely we will see a greater hindrance in terms of economic progress. Okay, so this may lead to a potential correction in the market. Okay, but I will believe that with Fed support, okay, they will have policies in place to cushion the blow. Okay, if you were to look at economic impact, okay, OECD estimates, they predict this a double hit scenario. Double hit scenario is whereby we see a second widespread virus outbreak. Okay, it will definitely cause a further dip, okay, in 2020 projected GDP growth. Okay, for the US, with the first outbreak, okay, projected GDP from them is already negative 7.3%. So with the second outbreak again, okay, their projected GDP may fall slightly further to negative 8.5%. Okay, definitely another risk, okay, will be the decoupling between the US and China. Okay, this may not play out in the near term, okay, because near term both countries are focused on economic recovery from this COVID impact. Okay, but over the next few years, we will definitely see more of this decoupling happen. Okay, we have to take note that trade war is not over. Okay, US tariff and China's retaliatory measures, okay, they still remain in place up till now. Okay, and with this pandemic, at the start of the year, okay, we do see severe disruption of a China supply chain. Okay, so this may further fuel sentiments for decoupling. Okay, but decoupling by itself, I believe it definitely will be damaging for firms on both sides. Okay, because if you were to just shift your supply chain, it will lead to a higher cost. Okay, and you may not find the most efficient product for your own operation itself. Okay, of course, a key concern on everyone's mind is whether valuation is getting very expensive. Okay, my answer is yes, it is. Okay, but there's a reason behind it. Okay, with a low interest rate and all this monetary stimulus, okay, definitely it will create some form of what we say valuation expansion. Okay, if you were to look at the table, across all sectors, okay, the forward P is actually trading higher than its 5-year average, okay, higher than its 10-year average. Okay, but moving forward, okay, up to the Q3 2020 earnings result, okay, these stocks will definitely be under pressure, okay, to deliver in order to justify its valuation. Okay, so do expect volatility moving forward, okay, be it in terms of upside or downside. Okay, because with this high valuation, okay, there is expectations for them to actually perform. Okay, if you look at the valuation of the market as a whole, okay, cap valuation is trading at the upper range of the band. Okay, but this does not mean that it won't get more expensive. Okay, it definitely can. Okay, but what I'm trying to say here is that with valuation this expensive, okay, definitely market has been pricing in a strong economic recovery, which in turn translate, okay, into a recovery in earnings, okay, for these US firms. Okay, of course, US election, okay, a lot of people wanted try to guess, who will actually win the US election. Okay, for me personally, I think it's too early to say. Okay, but historically, okay, we do see that election years tend to deliver a positive performance in the stock market. Okay, out of 22 election years, we see positive performance in 18 years. Okay, but for this case, there are very few election years where we actually see a crisis like this happen. Okay, so there isn't sufficient data, to match the current economic situation. But in general, okay, election years, we do see a positive performance. Okay, so for Trump itself, okay, his Trump card is definitely, okay, to maintain the market and of course to boost the economy, okay, in terms of economic recovery. Okay, so I will believe that he will do whatever it takes, okay, in order to sustain the market and to sustain the economic growth, okay, in order to boost his rating forward. Okay, of course, if you were to look at the poll average, okay, the blue line on the graph actually is the start of the Black Lives Matter movement and also the, the start of the resurgence, okay, of all these virus cases. Okay, so with that, for now, we do see Biden leading the race. Okay, but if you were to look at the past election, Trump has also been trailing behind the Democrats. Okay, but I mean, we all know who has the last laugh, right? We all know that who is the US president now. That's why I think it's still too early to say. But a key watch point, okay, is that if the election outcome, okay, A key watch point will be the election outcome of the current Republican-led US Senate. Okay, because if you were to have a Democrat control of the White House, the Senate, and also the House of Representatives, okay, it will make a corporate tax hike more likely. Okay, why is because in late 2017, okay, in late 2017, okay, Trump actually has this corporate tax cut. Okay, he cut the tax rate from 35% to 21%. Okay, so Biden, he has already made his intention, okay, that if he's elected, he will actually raise the corporate tax rate, okay, to 28%. Okay, so usually a rise in a corporate tax rate will definitely weigh on corporate profitability and even dividends. Okay, so moving forward, if it really happens, firms may see a more difficult path, okay, in order to maintain or to even grow their net earnings per share moving forward. And moving forward, this is accompanied by this impact from COVID, which will definitely drag on, I believe will definitely drag on further, at least until next year. Okay, but of course, some trends that you may actually want to hop on. Okay, we do see despite reopening, okay, there is still accelerating shift towards e-commerce. Okay, for retailers side, okay, they understand the importance to shift towards online stores, okay, in order to even continue their business operations. Okay, consumers wise, okay, we have all picked up online shopping, okay, for our groceries and also other needs. Okay, so in April, US e-commerce surged 49%. Okay, so if you were to look at the chart presented, e-commerce share of total retail sales, okay, it doesn't seem to be affected by the COVID situation at all. Okay, it has been year on year, okay, even up to first quarter 2020, okay, it has been boosting its share of total retail sales. Okay, so of course, people are definitely turning to e-commerce, and with reopening, okay, we still see e-commerce sales accelerated. Okay, which may indicate, okay, that a shift towards having e-commerce may have some form of permanence. Maybe, okay, the trend may be permanent. Okay, from this report, okay, of course, total online spending is actually up 77% year on year in May. So there's still definitely strong growth, which is accelerated through this COVID situation. And if you to adopt a longer term approach, okay, the future of e-commerce, there is still a lot of potential. We are looking at the rise of social commerce. Okay, we are looking at the rise of social commerce. Okay, we are looking at AR, VR retail. Okay, so if you're not sure what is social commerce, is basically using use of a social network, okay, in the context of e-commerce transaction. Okay, so some companies with huge potential for social commerce, okay, is of course we do see Snapchat, we do see Facebook, we do see Pinterest. Okay, those are with huge potential. Okay, of course, another trend we see, okay, will be the higher adoption of online and contactless payment. Okay, of course, this trend is definitely expected to last. Okay, government is starting to discourage the use of cash. Okay, we are all switching to contactless payment and mobile wallets. Okay, why is because a simple fact is that it does minimize physical contact. Okay, it does minimize physical contact, and we are all able to check out faster during transaction. Okay, which is in line with all this social distancing. Okay, Mastercard, for example, saw a 40% jump in contactless payment. Okay, but moving forward, okay, with reopening, okay, a question will be: are people still using contactless payment? Okay, I refer to this Mastercard Global Consumer Study. Okay, whereby they survey a huge group of people, 17,000 consumers in 19 countries worldwide, okay, on whether people will still use contactless payment. Okay, and what they found is that yes, majority, 74% of respondents state that they will continue to use contactless post-pandemic. Okay, so in a way, this suggests that sentiments towards a consumer behavioral shift, okay, could be a permanent. Okay, personally myself, I have also been switching to contactless payment, okay, even with all this reopening. Okay, of course, with the work from home trend, okay, we see that despite reopening, okay, mobility to workplaces, okay, still remains down, okay, below pre-COVID level. Okay, and from the chart, it seems that it has starting to, stabilize. Okay, and I believe that this shift towards having a remote working, okay, in a way will remain strong, okay, despite reopening, because in the future we are definitely less likely to return on, packed buildings that we see during pre-COVID days. Okay, and just a cross refer to a survey. Okay, they actually interview a few CFO. Okay, so they actually most of them, okay, have plans to actually shift their on-site workforce, okay, to remote position post COVID. Okay, of course, with all this work from home, okay, we do see growth in video conferencing. We do see growth in cloud software. Okay, because of course we are able to connect remotely, with minimizing human to human contact. Okay, so of course with a surge in usage for all these teleworking tools, okay, it brings about accelerating growth, okay, in cloud services. So if you look at the cloud space, right, okay, the cloud space is actually very huge. There are different components that encompasses this space. Okay, we are looking at SaaS, PaaS. Okay, I know all these terms may sound unfamiliar. Okay, I mean, due to time constraint, I do not have time to actually go through each of them. Okay, but these are actually out of all these, right? Currently, the largest industry is at SaaS, which stands for software as a service. So mainly they deal with licensing and delivery of software. Okay, over the internet. Okay, mainly through a subscription basis. Okay, so it definitely overshadow all the other components itself. Okay, if you look at SaaS, right, okay, it's a market size. Okay, currently it's at $72 billion. Okay, so it's expected, okay, to reach projected lah, of course, projected to reach more than $100 billion over the next 2 years. Okay, we also see a continued push for 5G. Okay, I think this COVID situation actually provide a very good opportunity, okay, for 5G applications to be tested across the various industry. Okay, for example, in China, we do see them, developing a online cloud learning platform, okay, to ensure that online education can take place for a huge amount of students. Of course, we are also seeing a remote medical consultations, okay, which I believe will be the next trend in the healthcare industry itself. Okay, and of course, accompanied with all this working from home and holding virtual meetings, okay, like what we are actually doing now. Okay, 5G will be highly sought after. Okay, main reason, of course, for its speed and for its bandwidth. Okay, definitely short term wise, we may see some slight delay. Okay, why is because, for example, in countries in Europe, we do see them having to postpone their 5G spectrum options. Okay, so short term, okay, there may be a temporary delay. Okay, but in the long term, okay, we may see a government focus in order to push for a productivity. Okay, just for example, previously Trump is considering $1 trillion infrastructure, investment spree. Okay, and part of it he intended to be used to develop a 5G network. Okay, and of course, going into the long term, okay, definitely there is still a large room for growth in terms of global digital adoption. Okay, if you were to look at some of the essential indicators of digital adoption, okay, there is still a huge gap in terms of internet users, in terms of social media users, in terms of mobile phone users. Okay, so definitely with this COVID-19, we may see a greater usage, okay, in terms of mobile phone, in terms of internet, in terms of social media. Okay, so I believe that with this COVID-19, okay, it actually accelerate, okay, the penetration of this 5G itself. Okay, of course, lastly, I see gaming and esports as entertainment for the new normal. Okay, we may potentially, see a longer term changes, okay, in terms of consumer habits, okay, towards video games. Okay, so this industry itself, is close to $160 billion industry. Okay, and forward CAGR, is around 7.7%. Okay, So year-on-year growth of the gaming market, okay, you can see that under mobile gaming, okay, it actually undergo a very strong growth of 13% year-on-year. So people are actually turning to mobile for their games, and of course, it's easy to know why, right? It's because first, due to social distancing, okay, PC cafes are closed. Okay, if you want to find entertainment, you want to play games, okay, you've got to turn to all these consoles, all these mobile. And for mobile, right, I mean, everyone has a mobile. Okay, smartphone is quite common nowadays. Okay, definitely, people are definitely turning to mobile as a form of entertainment. And of course, when we talk about mobile gaming, there is actually a very low barrier to entry. Actually, anyone can actually create their own mobile game. Okay, so there is actually a huge, a vast variety of different games. I mean, I'm sure all of you have played. Sorry. Okay, I'm sure all of you definitely have some form of games in your mobile gaming. Okay, but definitely moving forward. Okay, PC cafes, I believe it will definitely face a lot of pressure moving forward. Okay, and the next trend that is definitely being accelerated, okay, will be all this mobile gaming. Okay, PC gaming, not so much. Okay, I do only see strong growth in console gaming and mobile gaming. Okay, of course, areas to stay cautious. I know previously, a lot of people like to buy into airlines. Okay, they like to buy into cruises. Okay, because one day you can actually see a double-digit growth. Okay, you can actually close your position within the same day itself and earn like close to 20%. Okay, but for my end, I do stay cautious on this area. Okay, why is it? Because for airlines, okay, the focus is actually on survival right now. Okay, and they're actually incurring debt levels, okay, which will in turn continue to drag on their growth over the next few years. And if you were to look at the future of air travel, okay, the same flight, okay, because due to all this social distancing, okay, I don't think the same flight can actually carry the same amount of passengers pre-COVID. Okay, so what this means is that probably to transport the same amount of passengers, okay, you probably need to charter more flights. And of course, we do know that more flights means more cost. Okay, you may argue that they may pass on these costs to consumers, okay, but with higher costs, definitely some consumers will be deterred from non-essential traveling. Okay, so of course, with a second outbreak, okay, we are seeing delay in lifting of restrictions. Okay, yeah, this will definitely impact airlines moving forward. Okay, for cruises, okay, we do see operations suspended until mid-September. Okay, they do offer severe price discounting. Okay, but some price that they issue, okay, is still below their break-even cost. Okay, on their mindset, it's just to at least have some cash inflow for their businesses. Okay, and if you were to look at the recent areas of outbreak, if you were to look at Florida, okay, Texas, okay, they are actually one of the busiest cruise port in the US. Okay, so with outbreak in those areas, okay, I will foresee a delay in terms of cruises travel demand. Okay, of course, sorry. Of course, the travel industry, okay, I will believe that it will remain muted at least until a vaccine is launched. Okay, currently for vaccine in general, of course, we are looking at estimated emergency use by November, this year November. But of course, a mass production will only happen in early 2021. Okay, this is provided that nothing actually, there is no delay. This is more of an optimistic view. Okay, but recently we have been seeing, just a few days back, Moderna has actually delayed a bit on their trial processes. Okay, and of course, when I talk about the smaller caps with a high leverage, okay, particularly I'm looking at the oil and gas sectors. Okay, I know a lot of investors actually want to jump in because it looks very, very cheap. Okay, but in overall the oil and gas industry, okay, we are seeing a spike in leverage ratio. Okay, we will foresee asset impairment, okay, into third quarter 2020. Okay, and if you were to adopt a longer term, okay, we are actually seeing an accelerated shift away from fossil fuels. Okay, and just now from the mobility report, okay, you actually see that there is reduced transport demand, okay, where people are working from home. Okay, and even before COVID, right, okay, actually, if you look at the number of bankruptcy for this oil and gas, okay, it has already been trending up. Okay, so moving forward, definitely I'll foresee more bankruptcy to arise. Of course, if you want to go into oil and gas, it definitely is a value play. Okay, definitely you'll go for those who you think will be able to, in a way, better able to weather this storm itself. Okay, and with that, I've come to the end of my presentation. Okay, some disclaimer here. I mean, whatever I say is purely for sharing purposes. Okay, whatever counter that you see doesn't mean that it will be a great buy call, because I do understand that some of those counters are actually trading at very high valuation. So you really got to be very selective. Okay, moving into Q3, you have to be extra selective, especially with all those risks that I have brought up just now. Okay, so I will be looking at some of the questions. Sorry. First one is are some US bank stocks still considered too big to fail? Okay, for bank stocks wise, okay, previously, due to this COVID, we do see concerns about risks for the bank's balance sheet. Okay, due to they having indirect exposure to leverage in the loan market. Okay, but with Fed's massive support, okay, of financial conditions, and recently we do see they undergo this Fed stress test. Okay, they actually have a strong regulated mandated balance sheet, okay, that the banks need to follow. So if you were to look at there's this Fed financial stress index. So it's basically this index is essentially to measure the degree of financial stress in the market. So if you were to see, yes, there is a big spike, when COVID first started. Okay, but now it actually have normalized to safe levels. So in a way, it means that financial conditions have definitely improved dramatically. Okay, and with a reopening, of course, banks in the cyclical phase, okay, will definitely stand to benefit. Okay, but one thing is that I'm more concerned. Okay, even though I think that bank stock could be attractive in terms of valuation at this point in time, but definitely a risk will be in terms of the second outbreak. Okay, which is very hard for us to predict. I mean, it's a virus. We don't know how it will actually turn out. And recently there is a call that it could mutate. Okay, maybe it can mutate further. Okay, this one we won't know. Of course, the second outbreak, will cause all this rolling back. Okay, more rolling back of all this economic progress. So definitely, for me to rotate into a financial sector, probably I want to have a greater clarity. Okay, that they are able to keep the resurgence in cases under control, at least within those few affected states. Okay, COVID cases have been rising. Sorry. Okay, another question is COVID cases have been rising rapidly again in US. Is it time to be more defensive? Personally, yes, and that is why I brought out certain trends, because those are the trends that we still see, okay, despite reopening, and of course also despite when we were to really have a more massive lockdown, okay, it will just further fuel those trends which I mentioned, contactless payment, e-commerce. Okay, so I think that could be a safe play. Okay, it's definitely time to be more defensive moving into Q3. You definitely have to be more careful in selecting what you are buying. Okay, one question, will second wave of COVID will second wave of COVID result in the stock market drop to a level? Okay, I think this one I answered just now. Okay, this participant is asking whether we will return to the March 2020 low. Personally, like I mentioned, I do not believe so. Okay, we do see effects. The moment they say that they will take whatever it takes stance, okay, to provide all these kind of stimulus, I do not foresee that they will let stock market drop to the March 23rd low. But of course, this is my own opinion. Okay. There's actually a lot of questions. I don't think I can definitely answer all of them. Definitely I will not. I can't answer all of them. Probably I will just answer one more. I mean, I'm so sorry I really cannot answer all of them because my time is up. Okay, but do feel free to drop me an email. Okay, I will try to reply you when if possible. Okay, just now I do flash my email. Okay, you can revisit the previous slide. I will just answer one more questions. Okay, how will the escalating bankruptcy impact the stock market near term? Okay, if you see those bankruptcy that you see, some in the oil and gas sectors, their fundamental health is actually not that strong. They are actually having very huge debt. Okay, so if they were to go into bankruptcy, yes, it may impact the oil and gas sectors, but over the long term, probably those that are able to survive, okay, those that are able to survive through this period may be able to capture a larger market share. Okay, but of course, I'm not saying that oil and gas is a very it's definitely a huge potential, because I do see we are all shifting towards clean energy, we are shifting towards sustainable energy. So definitely we will still need oil and gas, but it is really a question of whether do we still need that much. Okay, so I'm still wary on these sectors. Yeah. Sorry, with that, I think I've overrun on my time. Okay. Like I mentioned, if you have any questions, feel free to drop me for a good discussion. Okay. With that, I will end my presentation here.